When a private company decides to become a publicly traded company, it decides to put forward its initial public offering, more commonly referred to as IPO. Most investors see it as a way to be a part of a company before it starts exponential growth. The idea of owning shares of the next big company before it's the next big company is every investor's fantasy. A company decides to go public as a way to raise money by issuing shares of its stock to the public for the first time. Selling shares for the first time allows the company to earn capital without taking on debt. IPOs were once viewed as an easy way to quickly earn really high returns, but that isn't the case nowadays. When you consider investing in an IPO, you should see it as a long-term investment rather than a quick way to a lot of profit. Now that you have it in your head that an IPO will be a long-term investment, you'll want to make sure you research the company to your fullest capacity. You want to invest in a company that has solid earnings and a practical business plan for the company's future. When a company is about to go public, it will file an S-1 form with the Securities and Exchange Commission, or SEC. It will also submit its prospectus with this form. The prospectus will clearly provide the following: a description of the company's business, properties, and competition, a description of the risks of investing in the company, a discussion and analysis of the company's financial results and financial condition as seen through the eyes of management, the identity of the company's officers and directors and their compensation, a description of material transactions between the company and its officers, directors, and significant shareholders, a description of material legal proceedings involving the company and its officers and directors, a description of the company's material contracts. When a company submits its paperwork with the SEC will investigate the company to ensure it is in full compliance with the Securities Act of 1933. If all goes well, the SEC will allow the company to issue common stock and make its market debut. The best tool for researching a company that's about to go public is its prospectus. This document will allow you to really evaluate what you can expect from the company right now and in the future. A company's prospectus tends to be quite long, so don't get overwhelmed by the amount of information it contains, but you should read as much about the company as you can. The prospectus is where the company outlines its risks and opportunities. You should specifically pay attention to the following questions. What does the company plan to do with the money raised from the IPO? The company may be planning to use the money raised from the IPO to repay loans or buy equity. If that is its plan, you should rethink investing in that company. Look at the company's income and balance sheet. How has it been performing in the past few years? A company with at least 2 years of profitability should see further profits. What banks are underwriting the IPO? Having a major or big bank as an underwriter signals that the IPO is worth the investment. A major bank wouldn't attach its name or risk its reputation for a company if it was a bad investment. Once you've gone over the prospectus, if you're still interested in the company and believe it has the market potential to enhance your portfolio, then here are 5 additional tips to further evaluate the IPO. Approach each IPO with caution. Do your research. Always review the company's prospectus. Evaluate any risk it might have and determine if any of the risks would affect the future of the stock. Avoid the hype. Don't invest in a company because it's getting a lot of attention prior to its public offering. You should be investing because it has a long-term potential in the market. Determine the value of the stock. If you think a stock might increase in value after going public, you should evaluate its potential to sustain that value. A lot of times, a stock can lose its value after just a few weeks of trading. Determine market viability. Make sure the company is entering the market in an industry that will have high demand. You want the company to have a long-term growth potential. One last very crucial tip. When and if you decide to get shares in an IPO, remember that you'll need to have a frequently traded account with one of the investment banks in the underwriting syndicate. Keep in mind that a good portfolio will include many diverse investments, and having a long-term IPO investment will enhance any portfolio, especially when you're investing in a valuable company with a platform that's able to mobilize through the market. All in all, when dealing with IPOs, you want to be skeptical but well-informed. Know as much as you can about the company's history, prior to going public, and where the company sees the future of its business. And most importantly, make sure the company's market will be a viable one.
If you like this video, please make sure to subscribe to the Wealth Daily YouTube channel using the button below. For even more investment tips and commentary, sign up for our free newsletter right here.